Dear friends, here we are today to calculate or actually to figure out how to calculate the FRTB standardized approach for sensitivity based market risk calculator. So we all know that FRTB has two approaches: a standardized approach for calculating the regulatory market risk capital and the internal model based approach for calculating via some internal model like value at risk. Okay, so this standardized approach is, it uses a sensitivity based approach, and it so it has a flow and it has a different method. I will show you that flow, okay, how the sensitivity is calculated, and I have created a calculator to calculate the different metrics for the FRTB, and I will show you. So for first thing, we have to calculate the sensitivity for each delta Vega curvature. Okay, so what is delta in the FRTB? Okay, so delta is nothing but what is the first thing, what is the standardized approach? So standardized approach is a factor based approach or a risk factor based approach. Okay, so you have certain risk factors. For example, if you have a bond in the portfolio, and so this bond has what risk does it have? That interest rates can rise or fall at a different tenors. Okay, so that is the risk in your portfolio. So those are your risk factors. And if you have risk factor, then you have risk, and then the regulator will want you to keep some equity position or equity capital in you in the funding structure, or the what we say capital structure of the bank. Okay, so whatever that risk is, okay, to your portfolio, a regulator will ask the bank to keep that amount as the equity capital in the funding structure, or what we say the capital structure of the bank. Okay, so that's the point. Okay, that's why we need to calculate FRTB, standardized risk capital charge. And why am I going for the standardized approach, not the internal model based approach? Because it is the simple approach compared to internal model approach, and maximum banks actually do the standardized approach, not the IMA based approach. And it is the, even if you are doing the IMA approach, okay, even then you need to do it, because there is certain floor below which the regulatory capital cannot go. Okay, so you cannot, so sorry, a bank cannot avoid calculating standardized approach. Okay, it is a must, it has to be calculated. Okay, and okay, for calculating, okay, so for calculating the regulatory capital, first we need to determine sensitivity to different risk factors, or the risk factors within the bank. Okay, so I have used a fictional portfolio. Okay, I will show you what my portfolio contains, and then I will show you how I calculated different sensitivities like delta sensitivities and curvature and Vega for my portfolio. I will show you. So this is my portfolio. As you can see, it has how many holdings in it? It has like 21 holdings. It is like fixed income portfolio, typical fixed income portfolio. And it has, I could have included cash in it, that would have zero risk weight. Okay, but it's not. And if as you can see that I have 21 holdings, and these are the different sectors, and all are actually investment grade. It is a investment grade portfolio, and the main point is that each one has a notional exposure of 2000. Okay, assume that it is referring some index where the constituents are equally weighted to the index. Okay, equally weighted index, not the market weighted index. Okay, so every notional is same for every bond, and there is a rating associated, there is a issue date, there is a call date for the bond. Okay, when the bond, and then maturity date, and there is a coupon date. So this is my fixed income portfolio. Okay, investment grade fixed income portfolio. Now can I calculate the sensitivity to different interest rates to it? Okay, as you can see, I have maturity till like 2030 to the 2025. So I can calculate maturity sensitivity up to like 5 years. Okay, up to 5 years. If I have tenors like 1 year, 3 year, 5 years, then I can get some sensitivity to each tenor I should get. Okay, so I have a program here to calculate sensitivity that I wrote. So this is my program to calculate sensitivity, and it will calculate sensitivity. Okay, and once it calculates sensitivity, let's see what sensitivities I got. So these are the sensitivities, and please wait for 1 second. Okay, so these are different sensitivities I got. So it is aggregated sensitivities. For bonds I got a sensitivity of 0.25 of 195 and 0.5 to 1537, and so these are tenors. Okay, and this is the dollar sensitivity. I could have printed dollar here for this portfolio, but I didn't, but the currency is here. So this is sensitivity at different tenors. Okay, yes, I have sensitivity now. What now? So once you got the sensitivity, then you can calculate delta risk charge. How to calculate the delta risk charge? That's the question. So this is a complete step-by-step procedure to calculate delta risk charge. Okay, and so what in the general interest rate risk class of FRTB, so there is a currency bucket, and there are, if your portfolio has like many currency buckets, then suppose there are three currencies in your portfolio, then you have three currency buckets. Simple as that. Currency is your bucket. Okay, and the tenor is a tenor inside that bucket. Okay, if your USD currency has like 3-year bond, then you can have like 1-year tenor, 3-year tenor, and 3-year tenor. Okay, so there are different regulatory tenors. Okay, and you have to calculate risk corresponding to those tenors. Okay, and if you want to know what the regulatory tenors are, let me figure out. Okay, I will do it for you. So these are regulatory tenors. There could be more. I think up to 10 there are regulatory tenors, but I did not go up to 10 because I did not have any bond more than that. So that's the point. And what do we do after that? Yes, you have to create currency buckets with actually when I fed these sensitivities to my portfolio, I replicated one more bucket. Okay, the exact bucket I created for euro, and where is it? I created one more bucket of euro, and I fed it to it. So I have two buckets actually, two currencies, euro and USD. And what are the risk weights? So now you understand the concept of bucket, right? Each, you have to, whatever currency you have buckets, and what is the risk weight for each tenor there is a risk weight. Okay, for each tenor there is a, let me understand. Okay, what are the different risk weights? Okay, for 0.25 1.7%, these are for risk weights for different tenors. Okay, as you can see that the maximum risk weight is for 3-month maturity. Okay, so somehow regulator believes that these bonds are the riskiest with the 3-year maturity. But as you go up to 5-year, okay, then it is very less. Okay, risk weight is very less. Okay, so what is the implication here? That okay, as you buy longer maturity bonds, okay, then the default risk decreases. So that is the implication here. So because as you see that risk weights are decreasing, if you have seen the risk weights for earlier versions like Basel 2 and 2.5, the risk weights increase if the risk in the position increases. Okay, so these are risk weights for different tenors inside a bucket. And what is here? So there is the inflation risk and this cross currency basis risk. Okay, if you have an inflation protected bond, okay, so this correlation is useful. My portfolio does not have. Okay, but important point being this inflation risk, you can treat it just like a regular tenor. Okay, and the treatment is specified in the FRTB approach. Okay, so it's not very complicated. We can easily add that, and even for cross currency basis. Okay, we can add and but important thing is, what is this gamma BCR buckets? Okay, it is for aggregating between two buckets, euro and USD buckets. Okay, it is used for aggregating between two buckets. So it is 50, correlation is 50. So it is so this is a correlation. Actually it is used for if I calculate the risk charge for USD and euro, then when I want to calculate combined delta risk charge for the two buckets, then this is relevant, 50. Then the correlations between tenors. Okay, so these are between tenors. Okay, as you can see the diagonal, 100%, 100%, 100%. Yes, obviously for if you are seeking correlation of 5 years versus 5 years, it is 100%. But yeah, but you can see that for quarterly maturity bonds to the 30-year maturity is 40%. Very little correlation between these two tenors. Okay, that also means that these rates of quarterly rate versus that 30-year rate, they move, there is very little correlation between them, very little correlation. Yeah, so some very useful insights here. So I have shown you correlation, the in inter-bucket correlation. Okay, this is inter-bucket, this is tenor correlation. Okay, inside bucket correlation, it is important. So this correlation is different. It is between two buckets, between euro and USD buckets. Okay, when you have bucket risk charge, then you can use it. Okay, but when you don't have bucket risk charge, okay, you are aggregating within the bucket, then you need these correlations. So that is important distinction. Okay, so now you have risk weights, and what is the use of risk weight now? Okay, you have a sensitivity of 0.25 years. Okay, I show you. So these are sensitivities, right, for 0.25 and 5. Okay, then you directly multiply the sensitivity with this risk weight. Okay, to get the risk weighted assets. Yeah, something to remember from Basel 2 and Basel 2.5. Okay, earlier Basel versions. So it is the same concept, nothing different. 0.5, multiply this number with this risk weight. Okay, very cool. Then this is the use of risk weights. Okay, I used percent, so you have to multiply by 0.01. Okay, then how do you calculate weighted sensitivity? For each tenor you get one sensitivity, right? Then multiplied with risk weight, you get weighted sensitivity. Quite awesome. Weighted sensitivity, just like Basel 2. Okay, now one important point. Okay, one important point, you saw some correlations there. Okay, tenor correlations between 0.25, 0.25. So these are tenor correlations, and let's call them medium tenor correlations. Why am I calling them medium tenor correlations? Okay, why? Because I will calculate two more correlations, high tenor correlations and low tenor correlations. Why? Because the correlation is very what I say, volatile parameter. Okay, it can change. It is not a perfect parameter. Correlation between tenors and between buckets, it can change, and because it can change, regulators have gone conservative on that. They have gone conservative. They have gone ballistic. They increase the correlation by 1.25 by factors, and then they do the entire calculations with the entire calculations with the high correlations. Okay, and they decrease the correlation, then they see the, okay, what is the risk charge with the low correlations. Okay, and they choose the highest, whichever correlation gives the highest risk charge, then they calculate it. Okay, so that's the point. Okay, and so that's the thing, medium correlation. So this you understand. Okay, it is straightforward, multiplied by 1.25, cap at 100%, simple enough for you. So this is also simple. K and L are tenors. Okay, low correlation. Okay, aggregate, then it comes aggregate. Now once you have the weighted sensitivities and the correlations inside a bucket, okay, what do? You aggregate all the tenor sensitivities inside a bucket. So I will give this program in the, okay, where is the program? This I will give this program to you in the GitHub. Okay, you can use it, you can run it actually, and you can get a good understanding. Okay, so it's quite cool. It saves the data as well, everything, every calculation it saves. Then you okay, yes, then you calculate the within bucket. Okay, so this is within bucket. See the weighted sensitivity of tenors. Okay, weighted sensitivity of tenor. Okay, and so use square every sign. So you have seen that a plus b square formula, right? Yeah, it is just like that. Just like that. Suppose if there are if the two sensitivities are perfectly correlated, okay, then it is a plus b, a square plus b square plus 2ab. Okay, weighted sensitivity k square plus weighted sensitivity L square plus 2 weighted sensitivity k to weighted sensitivity L. Okay, if you remember that formula, then it is easy to understand. They don't want you to keep it 0, but yeah, if the correlation is 0, then this part just disappears, then it only this remains. Okay, so that's the important point. Okay, now you have calculated for USD. Okay, remember I calculated. Okay, yes, these are low, medium and high correlations. If you remember, we discussed low, medium, high correlations here. So you will get three bucket numbers. That's it's important to know three bucket numbers: low bucket, medium bucket, and high. So that's important. Three bucket charts. So once you calculated the bucket, then how do I aggregate all the buckets? Okay. Obviously, after currency conversion, right? You have to convert euro into USD and then do conversion. For that, there is a inter bucket conversion correlation. This is the gamma between buckets B and C, and the process is very same. Okay, I think it is the same process. If you see, is it 100? Okay, it is exactly same actually. It is exactly same as you see. So this is same calculation for this gamma calculation as well. Okay, 75% of VC, it is absolutely same. Okay, no change in that. So similar way you calculate this low and high correlations for this gamma. Okay, then what do you do now? And low, okay, then you do a cross bucket aggregation. Okay, cross bucket. You have now USD and euro calculation, and remember, okay, there can be more currencies in your portfolio. Okay, yeah, there could be GBP, there could be yen, yuan, or Swedish krona, or Australian dollar, or Mexican currency, or Argentinian currency. Okay, so that's also possible. So yes, Indian rupee. Whatever currency you have to create a bucket, and inside that bucket there has to be tenors. Okay. Now GRG capital charge. Now okay. So this is again one formula. You just waited, do some wait. Okay. So they are calculating for the total delta risk charge. Okay, by aggregating of all the buckets. So these are SB and SC are some factors. Okay, the sum of weighted sensitivities, bucket aggregated sensitivity. Okay, let's call them bucket aggregated sensitivity, and then you apply this calculation. Okay, this is very similar calculation. Okay, it's not different. It's not different. So you will see the same calculation again and again. Okay, and then it's nothing. And then so they are checking if the bucket's risk weight is negative or not. Nothing different than that. Okay, they are checking if it is negative, and if not, then this is the exact formula. This is the exact formula. Okay, all so now you have calculated low correlation, medium correlation, and high calculation correlation capital charge. Okay, so this is a good news. We have achieved what we wanted to do. Okay, so yes, I was here, and this was my result. With this, my portfolio. And for the high correlation, it was 619. For the medium, 606. For the low, 593. Awesome. Okay. Now I wanted to show you for the curvature. Okay. Okay, so this Vega piece is missing here. That one I covered here for GIRR non-securitization. As you say that, as you see, most of the difference lies in how you calculate correlations. Okay, the main calculations for calculating delta, Vega, curvature. Okay, they are same between the risk classes, but only difference lies in correlation. So that thing I covered here for Vega calculation. Okay, this I need to do. So let's proceed to curvature. Okay, let's see how the curvature gets calculated. Where is curvature? One more important thing. Okay, why do you need curvature and Vega? Okay, for optionality. When there are optionality in a portfolio, in a security like callable bond, it has an underlying option in it. If investor has actually shorted the bond and the issuer is long the bond, right? So it has options. So that's why. And what does optionality do? It creates non-linear risks. Okay, if you remember the price to yield for a callable bond, that curve, okay, it is slightly curved. Okay, so that curve is your gamma. Okay, or we called convexity. So so there is a convexity behavior, that curve, and we try to capture that here. Okay, because delta is linear, and that curve that you capture through that these Vega calculation. Okay, how do we calculate it? Okay, we increase and decrease the volatility. Uh, uh, Volatility is an input parameter in that option. When you want to price that inbuilt option, and then volatility is the internal parameter, okay, for implied volatility. And how do you calculate the Vega sensitivity? You calculate Vega sensitivity by changing the volatility of the implied volatility, okay. Once you change the implied volatility, then you can calculate Vega. It is the sensitivity to volatility, think like that, sensitivity to volatility. And actually I have used what I have used. Okay, okay, we need sensitivity also. Okay, so one important thing for curvature calculation, sorry, it is curvature, actually my mistake. But yeah, I told you Vega. So curvature is it captures the curvature of the sorry, Vega was different. So Vega captures sensitivity to volatility for options, and curvature, it captures that curve in the bond, okay, that price to yield curve for capturing the non-linearity. So it also has the process, okay. And we need sensitive. You might be wondering, okay, why am I using this delta sensitivity for calculating curvature? Okay, why? Because it is required, okay. See this formula here in the end. When you calculated the curvature, okay, when you calculate the, you have to subtract the sensitivity, delta sensitivity. Why? Because okay, your total risk is made of two parts, okay, linear risk plus non-linear risk, okay, linear risk plus non-linear risk. So this calculation, okay, this calculation will capture both linear plus non-linear. That's the problem. V row up down minus V base, it will capture both. But if you want to subtract the linear risk, okay, then you have to do this process. Why do you see this 0.07? It is a regulatory risk factor, highest risk weight for 0.25 tenor, okay. So that's important, this subtraction is important, okay. And just like in the GIR, actually buckets are currencies actually. So yes, so that's why I needed sensitivity. But it is actually very straightforward. Once you understand the terminology of FRTB, then it gets easier. Okay. Okay, so for if we get the sensitivity for both currencies, okay, total sensitivities, then okay, that parallel shift is important. Parallel shift. Okay, now you have to do parallel shift, and then okay, currency notional, and okay, notional. There is a notional for each bond, okay. So if you remember, the notional was 2000 for each bond, and if you get the number of bond, then divide by 100, assuming that face value was 100, okay. Currency of bond, base price, multiply by position to get base price. So this is the base price of the bond, okay, the price today, okay. Okay, okay. So if you want to see this curvature calculation, then I can okay, so this code is also I have, okay. This was delta, and this is f, okay, this is the curvature, okay. So what I have done, it is the same, virtually same code, but what I have done, the increase, there is a simultaneous increase and decrease in rate. Shift size is C, there is weight. Shift size is 1.7%. It is higher than GIR delta, okay. I think there it was 1 bips or 1%. I think it here it was if you see here, what was the shift size for when we calculated sensitivity? Let's see. Okay, sorry, it is taking a little bit time. Let's see it now. Shift size was 1 basis point, okay. In this case, it is 1.17%. and it is much more. You see, in the curvature we shift the curve, the parallel shift curve, all the tenors in up and down, okay, by a lot more amount. See, for curvature it is like very severe. uh, yeah. So why 1.7%? Because it is the highest risk weight for GIRR. So we shift up and down, and after the shift, what do we do? Let's see. So your base price was somewhere here, which is the today. This is your clean price today. Then you rates up, you increase it by rates, okay, all the tenors up. Then you curve up. This is your curve up. Okay, this is Hull White model. Okay, volatility is 0.15. Sorry, 1.5%. If you remember, for the Vega calculation, we increase it by 1% and decrease it by 1%, and then calculate the Vega sensitivity. So I can show you here somewhere. So Vega sensitivity code is I also have, okay, and this is mean reversion parameter for in the Hull White model. And you calculate, and then you shift the whole curve up. Okay, this is parallel shift, and then you shift the whole curve down, the parallel down shift of the whole curve. And then yeah, so after that you do the calculation, okay. And what is the calculation? Let's see, it must be here somewhere. But the important point being the price up minus it must be there, price up minus price down by base price, okay, it does not change, okay. See, yeah. So this is v risk weight up, okay, the price when you increase the curve increased, okay, and base price minus sum. So this is a curvature for a bond, okay, this is a curvature for and you do it for the same for the bond down curvature, okay. And then what do you do? Then you calculate the risk weight as maximum of both, whichever is bigger, then you calculate that as the KB, maximum of curvature up and curvature down. Then you calculate the psi. It is simple. It is zero if the both buckets have a negative. Both are negative. Otherwise, it's one. Okay, that's the only point. Okay. Okay. So yeah. So I think there was some aggregation done for all the bonds. Okay. For that max curvature. Okay. I think yeah. Right. Okay, the and the correlation factors are same, okay. Correlation is calculation is same, like I told you about these correlations, medium, low, high, and these are the curvature calculations, okay. So main point was to calculate the curvature, okay. After you can assume the curvature just like the bucket risk charge, and then okay, so that was the main thing. Okay, I hope that was clear enough. Let's move to the non-securitization. Sorry, let's see what we have covered and what needs to be covered. So we have covered GIRR delta and GIRR curvature, and now the CSR non-securitization. Okay, what is CSR non-securitization? Credit spread risk. Okay, credit spread risk. Suppose you have a corporate bond, then it has some credit spread embedded in it, okay. So that credit spread will cause some risk, that credit spread, okay. It can go up and down, obviously. Corporate there the risk to, sorry, the credit quality of that corporate issuer can go up and down, and that will increase or decrease the bond value of the bond, okay. So that's your credit spread risk. And it is non-securitization. That means, okay, non-securitization means, okay, I'm not selling sorry, buying MBS, ABS, CLO, these types of bonds where they securitize, means combining a lots of underlying assets and then selling, using them as collateral, and selling bonds by using those as collateral. So that's the main thing. And how do you calculate delta for CSR? That's the main point. Let's see. delta CSR. I think this is the delta CSR. Okay. So okay, you must be wondering why did I use bond CSR's delta. Okay. CSR delta. I used sorry, FRTB GIR delta as CSR delta because interest rate has two components. Okay, risk free rate and CSR rate, credit spread rates, spread rate. So I did not have capability to split the interest rate into two parts. Okay, credit spread and real rate. So Basel provides a guidance. Okay, Basel provides a guidance that there is a clause that you can use your delta sensitivities as inputs as your CSR delta sensitivities. Okay, so I have used that clause to reuse the same delta GIR sensitivity as CSR delta sensitivities. Okay, so that's all, nothing different. And so what is different, okay, that I wanted to show you in the CSR versus GIRR. Okay, one thing is important, IG versus high yield, that distinction becomes important. Okay, IG versus HY sorry, IG versus HY. So this is investment grade versus high yield. Okay, sector is important. Okay, your bond belongs to which sector, please. So this is all hypothetical. I have used some freedom. I know that Pfizer is not local government. Okay, Verizon is not sovereign. Okay, so important thing is the methodology. So this is the CSR bucket, and these are the risk weights. Okay, so risk weights come from bucket. Each bucket has a risk weight. So you see this bucket come, each bucket one has this risk weight. Okay, bucket two has this risk weight. Okay, bucket three has and you see this sector is also important, and sector means bucket only. That is important, and that determines your risk weight. And what is the important thing, other important thing here, this IGHY. Okay, IGHY, I think rating is also important. And all of my bonds are IG, but this get is important in calculating correlations between different bonds. So let's see what it is. Okay, there are these okay, so this we have already discussed, risk weights, and bucket we have already discussed. So this is jig sector. Okay, that sector I was showing you. And then we go down, these are the tenors. Okay, in for the CSR. And these are the okay bucket correlations for CSR. Okay, it has bucket, the correlations between different buckets, that is important. Okay, let me show you what that looks like. It looks like this. Okay, for example, correlation between bucket 1 and bucket 3 is 10%, bucket 1 and 4 is 20%, like that. Okay, CSR tenors, these are the tenors. And so CSR tenors are fewer than GSR tenor. Okay, so that's an important point. There are fewer, so you have to do some interpolation. So you have to assign 0.2 to 0.5 CSR tenor if you have any 0.2 year GIR. Okay, and 2 years will be allocated to again one more interpolation. Okay, so you can calculate weighted sensitivity based on risk weight, just like for the GIRR delta. Okay, and then you have to calculate within a bucket, you have to calculate sensitivity in a bucket. Okay, sorry, not the sensitivity, weighted sensitivity within a bucket. Okay, so if it depends on how many issuers or bonds are there in a bucket. If there are 4 holdings, then there are 28 sensitivities and 378 correlations within the bucket, because 28 sensitivities means every bond can have sensitivity with any other bond. So that's why there are sensitivities, and there are like and there are like 378 correlations. So yeah, every bond can have different correlations. Okay, let me see it again. Okay, okay, okay. So this is bucket 1, and there are different tenors inside this bucket. So what is it doing? Okay, so what I told you earlier, that correlations are important. Correlations correlations are important. How do you calculate correlations? The name is important. Okay, if oh, sorry, okay, so these are tenors are important, and name both, tenor and name both is important. Okay, so these calculations, tenor means my Apple bond could have okay, let me show you, sorry, I don't want to confuse you. Apple bond has these many tenors. Okay, so there is a 0.2y Apple bond. Okay, there could be 0.2y JP Morgan bond. So there is a correlation to this, but there is a correlation between these two as well. Okay, when the correlation between the within a bond tenor, then the name is same but tenor is different. But there can also be case where tenor is different and name is also different. Okay, so they have taken care of both, so they just multiply two correlations like this, name and tenor and basis. Okay, so basis I have not used, I have assumed basis equal to 1, but it is used it is calculated in a different way. So name means now you understand that name means Apple bond JP Morgan, and tenor means 0.2y or 0.5y. Okay, so this is the methodology, and this is a high, low, and those correlations are same everywhere. And then this formula you may have seen, you have seen it. Okay, and this is another correlation, then it gets different here, you see. Rating versus sector, what I told you earlier, rating was important. Rating was important. So if the rating is different, then where it is one because all my buckets are easy. Okay, 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 I have all of my bonds are investment grade, so rating is equal to 1. Okay, it makes it easier. But if I had used HY, then this calculation would have been different. Okay, this can expand, there is a scope for expansion here. And then the sector, okay, so I have 4 sectors, I believe. Okay, if their bonds of same sector, but okay, sectoral correlation is also okay. Let me see sectoral correlation. Okay, let's try to see what we have. Okay, I will show it to you later. I have loaded it in the GitHub, and in the end I can show you this sheet. But okay, but the important thing is that those sectors have different correlations. Okay, that's the important thing that you should understand. But let me try to show you the holdings. Okay, that will make it clear. So you see there are different sectors, that basic materials is a sector, and sovereigns is a sector. So these are different sectors, and the important point being these two have different correlation, and these two have different correlation. That's the important thing. Okay, that sheet has those correlations. Okay, so just like previous GIRR, we have to calculate high, medium, low correlations. Okay, no escaping that, no escaping this high, medium, low, and this calculation is same actually. Yeah, this calculation is same. Actually I wanted to show you this CSR non, I must have it somewhere. Okay, CSR non, okay, let me try to figure out where it is. Okay, I will show it later. I will move on to the next. What it is, this Vega calculation. Okay, so this is important because I have not covered it yet. It was not in GIRR. Okay, so what, so but first thing, okay, what do you need to know, how did I calculate Vega sensitivity, and what it is? It is sensitivity to the implied volatility. So that is the risk factor, implied volatility for Vega. I shifted it by I think 1.7%. That's what I showed you there, and down by 1.7%, then I calculated based on that. Okay, FRTB Vega sensitivities. Okay, so let me try to get this sheet. Delta correlation contains correlations between. So the important point being that there is a security name, and for each tenor there is a Vega sensitivity. Okay, so you can increase sensitivity at each tenor. On 1 year Vega sensitivity, 2 1 years, and Vega sensitivity, or 3 year tenor and 5 year. Actually, let me search for it. Okay, let me search for it. Okay, this is the file. I think this is the file. So these are the Vegas. Okay, for each bond I have calculated Vega. Okay, and for each tenor the Vega is applicable. Okay, one for 1 year there is a different Vega, for 3 year different Vega, and 5 year different Vega. Okay, it is applicable at each tenor. So it's at each tenor, as you see. All right, for each bond. And there are also like delta correlation. Let's see. These are the correlations. Okay, so these are the same correlations, delta correlations, both for GIRR. Okay, they are also applicable for Vega. And these are like sectoral correlations. Okay, so this also you have seen before. Okay, nothing new. And okay, so that's the same. So this process is actually so now the important thing is option expiry. Okay, so what, there is one thing that needs to be remembered. Okay, so there is something called option expiry, and for each option expiry there is a tenor. Okay, suppose there is a bond which expires at like 3 years, so then that underlying option also expires in 3 years. Okay, then it is based on call date. Okay, this is based on call date, and then you allocate, then you need to fill this correlation matrix based on this formula, and it is a constant correlation matrix. And yep, so yes, that needs to be filled, and after that it is the same correlation calculations and the same rating and sector correlations which we showed earlier. Okay, but the new thing was that this thing actually, this is a new option expiry, based on option expiry. Actually, this has to be filled. It is inside my code. Okay, please have a look how it is being done, and I will be able to answer questions based on that. And the correlations are same, and everything else is same actually. And the last point actually, the gum the curvature. Okay, so this is the curvature, and it is the almost the same thing. It's nothing different actually. Curvature up, curvature down, nothing different. You have seen the buckets. So that's the main thing, crux of the FRTB calculations. Okay, it is same in every risk class. Okay, it does not change. Okay, what I have covered, I have covered GIRR and CSR. Okay, so these need to be covered. Okay, uh, okay, so these I have not done yet. Okay, so what we have covered sensitivity definition, risk factor definition, intra. Okay, so these things we have covered. Okay, uh, I can show you the GitHub code. Okay, let's see if I have the GitHub code ready. GitHub. So I have pasted every code, okay, every file here, every code. So these are GIR delta bond sensitivities code and file here. I have to rename this folder. I will rename it. This is delta risk charge, curvature risk charge. So you will find inputs and outputs here, okay. For example, if you go there, then you will find one py file. This is the calculator, okay, Python calculator. These are my holdings, these are the rates, okay, these are the rates, okay, what are the rates? Let's see. Okay, so these are the rates actually. So I picked them from Fred site, and so these are 6 month, 1 year, 2. These are the rates. And what is the important thing? And now you this is delta, and this is the output, okay. These are, since this is the output, again I go to delta risk charge, and again it needs those sensitivities, right, okay, to calculate, and the weights of course. Then it calculates the these, and this is the calculator, and this is the PDF. If you want to see, okay, PDF is opening. Yeah, it is the same PDF that I was showing you. And this the same for curvature, okay. There is a PDF there which is the like readme version, readme. Treat it like readme. And why it is, and board holdings, again the board curvature, that a calculator, and some excels which are input output files. And this yeah, that's all. And let me see if anything is pending. Yeah, I think I have covered everything. So thank you everyone for listening to my description of FRTB. I hope this was good for you. You are able to understand at least something out of this discussion. Have a great day, buddy. Thank you.